Welcome to the deep dive. Today, we are focusing laser-like attention on the Q3 2025 earnings results for SoFi Technologies. And importantly, our entire analysis today is pulled directly from the prepared financial remarks delivered by the CFO, Chris Lapointe.
That's exactly right. We're aiming to give you, our listener, a really clear, detailed picture of the company's financial health, how the different parts of the business are doing, their capital situation, and critically, that revised outlook for 2025. All straight from the CFO's script.
Yeah, and the big headline right off the bat, the thing that really underpins this whole discussion, it seems, is that acceleration they talked about, the move towards capital-light, non-lending revenue. And that shift, combined with, well, frankly, massive increases in profitability and tangible book value, it led management to significantly raise their guidance across the board for 2025.
It really did. Quite a statement.
Okay, so let's unpack this, starting with those headline financials for Q3 2025. Now, this was their 8th consecutive profitable quarter, which is quite a run.
It is. And yeah, they hit records pretty much everywhere. Adjusted net revenue, for instance, a record $950 million. That's up, 38% compared to last year?
38%. That's strong growth.
It is. And the key thing, I think, is that it looks like durable, profitable growth. Adjusted EBITDA also hit a record $277 million. That works out to a very healthy 29% margin for the quarter.
29% margin, okay.
And net income landed at $139 million. That's about 11 cents per share. Now, the CFO did mention a small benefit from a lower tax rate, but, the core profitability story seems fundamentally solid.
Right, the underlying performance is there, but the real strategic shift, you mentioned it earlier, the one that probably gets investors focused on efficiency excited, is moving away from just relying on loans held on the books, right, towards these fee-based services.
This is where, the story gets really compelling, I think. They're non-lending businesses, that's financial services and the tech platform together. They generated $534 million in revenue.
Over $500 million.
Exactly. And that's up 57% year over year. So if you connect this back to the strategy, it means the fastest growing part of their business actually requires the least amount of regulatory capital.
Which builds resilience.
Precisely. It's building a more durable profit engine for the long run.
And if we drill down even further on those capital-light streams, the CFO noted that total fee-based revenue across all the segments hit a record $49 million, up 50% year over year.
Yeah, 50%. It really confirms that the model is successfully diversifying away from just, interest rate dependency.
So heading over $500 million quarterly from financial services and tech combined, it really does seem to prove out that strategic idea, doesn't it? That they can be more than just a lender.
Absolutely. It shows they can succeed as this holistic financial service provider.
Okay, now let's dive into the individual segments, because this is where we see exactly how that profitability is being, manufactured. Let's start with financial services, or FS.
Right, the FS segment, it's clearly the monetization engine right now. Net revenue there just soared to $420 million. That's a huge 76% increase year over year.
76%, wow.
But, maybe even more important than the top line revenue is the efficiency. The contribution profit was $226 million.
Okay.
That's nearly 2.3 times what it was last year. And it results in a really quite impressive 54% contribution margin.
54% contribution margin from that segment. That is staggering. And the CFO pointed to non-interest income as the main driver there.
That's right. It grew almost 2.6 times, hitting $216 million just for the quarter. If you annualize that, you're looking at over $860 million in high-quality fee-based income.
Which really speaks to that cross-selling idea, getting more from each member. Did the CFO provide any metrics on that?
He did. The data suggests it's working. Financial services revenue per product actually went over the $100 mark for the first time. It reached $104 in Q3.
$104 per product.
Yeah, and that's up over 28% year over year. So it confirms they are, getting more revenue from each product a member decides to hold with them.
And fueling that usage, I imagine, is the payment side. Cards and money accounts.
Definitely. Interchange revenue jumped 55% year over year. The CFO attributed that to nearly $20 billion in total annualized spending across their SoFi money and credit card products.
$20 billion in annualized spend. Okay. But tucked inside this FS segment, there's also that capital-light lending piece, right? The loan platform business, LPB.
Yes, good point. The LPB, it's essentially their origination as a service model. It generated $168 million in adjusted net revenue in Q3. That was up 29% just from Q2.
29% sequentially.
Sequentially, yeah.
Yeah.
And crucially, The CFO highlighted that $165 million of that revenue came from originating $3.4 billion of personal loans on behalf of third parties and through referrals.
So that's pure fee generation, no balance sheet risk for SoFi on those.
Exactly. No balance sheet required for that specific activity.
Okay, let's just quickly touch on the tech platform, the TP segment. That's the sort of foundational tech powering all this.
Right. That segment delivered $115 million in net revenue. It was up a more modest 12% year over year, and the contribution margin there held steady at 28%.
So it's growing, but clearly FS is providing most of the current growth boost.
Absolutely. You could say the tech platform provides stability, maybe, but financial services is delivering the rocket fuel right now.
Okay, makes sense. Now let's pivot to the traditional lending segment, still a massive part of the business, of course.
Still huge, yeah. Adjusted net revenue there was $481 million, up 23% year over year. And net interest income, or NII, that's the revenue they keep from the loans they actually hold, that grew 35% year over year to $428 million.
And that NII growth must be supported by pretty significant origination volume.
Oh, staggering volume. Total loan originations for the quarter hit a record $9.9 billion.
Almost $10 billion in one quarter.
Yep, a 57% jump from the prior year. And they hit specific records within that: $7.5 billion in personal loans, $1.5 billion in student loans, and $945 million in home loans.
A 57% jump in originations is, well, it's massive. Did the CFO mention anything about efficiency gains or automation that let them scale that much? Because that usually implies higher costs.
He did touch on it. The ability to scale like that seems to come from two main things, according to the remarks: ongoing automation within their application process, and then, crucially, using the capital markets really effectively to rapidly offload exposure when they choose to.
Ah, the loan sales.
Exactly. This quarter, they sold and transferred a record $4.6 billion worth of personal, home, and student loans, partly through that LPB mechanism we mentioned.
Okay, $4.6 billion sold or transferred. What does that volume tell us about their pricing power, their ability to execute those sales profitably?
It tells us they're executing highly profitably based on the numbers provided. For instance, the CFO detailed a sale of $175 million in personal loans at an execution rate of 106.4%.
106.4%. So they're selling above par.
Precisely. If you connect that to the strategy, an execution rate over 100% means they're generating an immediate premium on the face value of that loan. So they realize profit up front, turning what could be a capital-intensive asset into immediate low-risk fee income.
Right, that perfectly illustrates the flexibility of that hybrid model. We should probably also mention the CFO noted an opportunistic sale, something about delinquent loans.
Yes, they sold $90 million of late-stage delinquent personal loans. The commentary suggested this was done strategically to generate positive incremental value now, rather than just waiting for them to charge off down the line. It shows pretty active portfolio management.
Okay, so we've established massive revenue growth, efficiency gains, but for any lender, especially one growing this fast, that always brings up the critical question. Is the growth high quality? Let's look at credit performance and capital strength.
Right. And the remarks continue to emphasize that their focus on prime and super prime borrowers is really paying off. The weighted average income and FICO scores for new loans remain exceptionally high. For personal loans, the CFO cited $157,000 average income and a 745 average FICO.
Pretty high hurdles. And what about the actual credit trends within the portfolio? Are they holding up?
They seem to be improving, actually, which, as you said, is genuinely impressive given the broader economic backdrop. For personal loans, the annualized charge-off rate actually declined by more than 20 basis points quarter over quarter. It dropped it to 2.6% from 2.83%.
Down 20 basis points. Okay. And student loans?
Similar story there. Student loan annualized charge-offs also declined more than 20 basis points, down to just 69 basis points from 94 basis points previously.
69 basis points is quite low.
It is. And the crucial takeaway the CFO seemed to be driving towards was confidence in their long-term loss modeling. The data, he argued, continues to support their long-term NCL, net cumulative loss, assumption of around 7% to 8%.
And that confidence isn't just theoretical, it's backed by recent history.
Exactly. He pointed to recent vintages, specifically loans originated between Q4 2022 and Q4 2024. Those currently have an NCL of only 4.4%, with about 39% of the principal still remaining unpaid.
Okay.
So that's tracking well below the path of their, say, 2017 cohort, which is mentioned as sort of the last vintage that really stress-tested the higher end of that 7% to 8% loss range.
Got it.
Mm-hmm.
Okay, now onto the capital side. This quarter saw a pretty major balance sheet transformation, didn't it? Largely because of that big equity raise back in July.
That's right, an opportunistic $1.7 billion common equity raise. It provided a huge capital buffer, obviously, but equity raises typically mean dilution, which shareholders don't usually love.
So how did the CFO frame that? How did they justify adding that many shares?
Well, the justification presented was really centered on the immediate financial strength it created, and especially the resulting increase in tangible book value, or TBV. The argument is, while there's some temporary dilution, this massive capital injection lets them fully fund the profitable growth businesses, ultimately creating more long-term value.
And the TBV numbers reflect that.
They do. TBV grew by $1.9 billion just in the quarter, sequentially, reaching $7.2 billion.
Okay, $7.2 billion total. But what does that mean on a per-share basis, considering the dilution?
That's the key point. TBV per share ended the quarter at $5.97. And that represents a massive 46% increase year over year, even with the new shares.
46% increase in book value per share year over year.
Exactly. So essentially the message from the CFO is, we've successfully ring-fenced the company with a massive financial buffer, significantly reducing sensitivity to future market shocks or regulatory changes.
And the regulatory ratios back that up.
They do. The total capital ratio was reported at 20.2%, which is way above the 10.5% minimum requirement.
Yeah.
Very well capitalized.
Okay. One final point maybe on the capital and income side. Net interest margin, NIM, how did that fare with all these moving parts?
NIM was remarkably stable, actually. It came in at 5.84%, which was down just 2 basis points sequentially. Very small change.
And the outlook for NIM?
What's important here is the forward guidance from the CFO. He stated they anticipate healthy net interest margins remaining above 5% for the foreseeable future.
Even with that strategic mix shift towards more fee-based income.
Yes, even with that modest mix shift in interest-earning assets, it suggests confidence of their funding costs and asset yields.
Okay, so summing that up, record performance, seemingly improving credit quality, and a vastly strengthened capital buffer. That strength then logically leads us to the final big piece. The significantly revised and elevated 2025 outlook.
Yeah, this is really the definitive proof of management's confidence, pulled directly from those Q3 results. The fact they raised guidance so dramatically across every major metric for the full year 2025, it shows they believe this growth engine isn't just durable, it's actually accelerating.
Right. Let's quickly run through the new expectations versus what they guided to previously on member growth.
They now expect to add approximately 3.5 million members for the full year. That's about 34% growth year over year, and it's up from the prior guidance of 3 million.
Okay, 500,000 more members expected. What about revenue?
Adjusted net revenue target was raised significantly, now aiming for approximately $3.54 billion. That's up from $3.375 billion previously.
Yeah.
So implies about 36% year-over-year growth.
And the profitability forecasts, those must have jumped too.
They soared, yeah. Adjusted EBITDA is now expected to be approximately $1.035 billion. That's up substantially from the $960 million guided before.
Over $1 billion in EBITDA.
And adjusted net income saw an even larger proportional increase, now expected to be around $455 million. That's a hefty jump from the previous $370 million guidance.
Wow, okay. But the most dramatic change, the one that really caught my eye in the summary, was tangible book value growth.
Yes, that was perhaps the most striking revision. They now expect approximately $2.5 billion in TBV growth for the full year.
$2.5 billion, up from what previously?
Up from guidance of around $640 million previously.
That's a massive change, almost 4 times the previous expectation for book value growth.
It's a huge injection of capital flexibility. If you connect this to the bigger picture, that kind of TBV jump fundamentally changes the game in terms of future strategic options, right? Whether that's handling unexpected regulatory hurdles, funding even faster growth, maybe even considering acquisitions down the line. The CFO has effectively given the company a virtually unprecedented financial runway based on these new numbers.
What an impactful deep dive, focused just on those prepared remarks. The Q3 2025 results, as laid out by the CFO, clearly demonstrate durable growth, increasingly powered by capital-light revenue. We saw improving credit quality trends and this massive increase in capital flexibility, all culminating in dramatically improved expectations for the full year.
Indeed. It really signals, based on his commentary, a successful and highly profitable transition towards being a more diversified financial platform.
So here's a final provocative thought for you to consider based on something the CFO mentioned. He noted they expect healthy net interest margins staying above 5% for the foreseeable future, even with that shift towards fee generation. Now, given their huge capital buffer and that growing reliance on capital light fees, what does the continued strength of the NUM really suggest about their underlying competitive advantage, maybe in their funding structure, as they navigate whatever future interest rate environments come their way? Is that low-cost funding base truly as durable as these results imply? Something for you to mull over.